Gold bugs say Bitcoin is fake internet money. Bitcoin maximalists say gold is a boomer rock. Both sides are wrong. Both sides are also partly right. This debate matters more than most people realize. We're living through the biggest monetary experiment in history. Governments are printing trillions. Inflation is destroying purchasing power. People are desperately looking for something that holds value when everything else doesn't. Gold has done this job for 5,000 years. Bitcoin has done it for 15. One is ancient and proven. The other is new and explosive. This video breaks down the honest comparison between Bitcoin and gold, where each one wins, where each one fails, and how to think about both in a world where the dollar is losing its grip. Gold has been money for 5,000 years. Every major civilization used it. Roman Empire, Egyptian Empire, Chinese dynasties, British Empire. It survived every government collapse, every currency failure, every war, every financial crisis. The properties that make gold valuable, scarce but not too scarce, dense store of value, doesn't corrode or degrade, universally recognized, divisible into smaller amounts, cannot be printed or created artificially. The track record: people who held gold through the 1971 dollar debasement, through 1970s inflation, through 2008 financial crisis, through COVID money printing, all preserved their purchasing power. Gold in 1971 was $35 per ounce. Today it's over $2,300. That's 65 times in 50 years, while the dollar lost 95% of its purchasing power. Gold works. History proves it. Bitcoin was created in 2009 specifically to solve what gold couldn't. It's digital, portable across borders instantly, verifiable without trusting anyone, capped at exactly 21 million coins. No government can print more, no central bank can manipulate supply, no physical storage required. What Bitcoin does better than gold: you can send $1 billion in Bitcoin across the world in 10 minutes. Try doing that with gold. You can verify Bitcoin's supply in real time by running a node. Gold's supply requires trusting assayers and central banks. Bitcoin's rules can't be changed without consensus. Gold's rules can be changed by governments. Confiscation of gold has happened. The US government confiscated gold in 1933. Self-custodied Bitcoin cannot be confiscated. Gold's supply increases by approximately 1.5% to 2% per year as new gold is mined. That rate is relatively stable, but it means inflation. Bitcoin's supply increases at a predetermined rate that halves every 4 years, currently around 0.9% per year. After 2028, it will be 0.45%, eventually zero. Bitcoin is provably more scarce than gold. We know exactly how many Bitcoin will ever exist, 21 million. We don't know exactly how much gold exists. Deep-sea mining, asteroid mining, and advanced extraction could theoretically increase gold supply significantly. Bitcoin's supply is mathematically guaranteed. Gold's supply is not. $1 million in gold weighs approximately 17 kilograms. Getting it across a border requires physical transport, customs declarations, security risks, potential confiscation. $1 million in Bitcoin weighs nothing. It exists as 12 to 24 words in your head. You can cross any border in the world and reconstruct your wallet on the other side. For people fleeing authoritarian governments, war zones, or economic collapse, Bitcoin's portability is life-changing. Gold's portability is a serious limitation. Venezuelans, Afghans, and Ukrainians who held Bitcoin could take their wealth with them. Those who held gold largely couldn't. How do you know if gold is real? Specialized equipment, expert assayers, complex testing. Even then, gold bar fraud exists. Tungsten-filled gold bars have appeared in major vaults. How do you know if Bitcoin is real? Run a node. Your computer independently verifies every transaction in history. No trust required, no experts needed, no equipment required beyond a computer and internet connection. Bitcoin's verification is trustless. Gold's verification requires trust in institutions and experts. Gold's annual volatility is approximately 12% to 15%. Bitcoin's annual volatility is 50% to 80%. Gold is significantly more stable. A $100,000 gold position might swing $15,000 in a year. A $100,000 Bitcoin position might swing $70,000 in a year. For people who can't stomach volatility, gold is more comfortable. For people who understand Bitcoin's trajectory and have a long time horizon, the volatility is the price of admission for asymmetric returns. Gold has never 10 times in a year. Bitcoin has done it multiple times. The volatility cuts both ways. Gold from 2010 to 2026, approximately 3 times to 4 times returns. Bitcoin from 2010 to 2026, approximately 10 million times returns from the earliest prices. Even from 2015 to 2026, Bitcoin approximately 200 times, gold approximately 1.5 times. The return difference is not close. Bitcoin has massively outperformed gold over every meaningful time frame since its creation. Past performance doesn't guarantee future results, but the magnitude of the difference suggests Bitcoin captured something gold couldn't in the digital age. 1933, US President Roosevelt signed Executive Order 6102, requiring Americans to turn in their gold to the Federal Reserve at $20.67 per ounce. Those who complied lost their wealth protection. Those who hid gold risked criminal prosecution. Physical gold held by ETFs or banks is subject to government seizure. Governments know where it is. Self-custodied Bitcoin held on a hardware wallet with a memorized seed phrase is essentially seizure-resistant. Governments can ban Bitcoin exchanges. They can ban Bitcoin businesses. They cannot seize Bitcoin from someone who memorized their seed phrase and stored nothing digitally. This is a fundamental difference in confiscation risk. The world is becoming digital. Value is becoming digital. Communication is digital. Commerce is digital. Finance is digital. Gold is physical. It was the perfect money for a physical world. Bitcoin is digital money for a digital world. The generation growing up today has never experienced a world without the internet. For them, digital scarcity is as real as physical scarcity, maybe more real. Gold's physical nature is a feature for people who experienced the pre-digital world. For digital natives, Bitcoin's properties are simply more relevant to how they live. Gold institutional adoption complete. Central banks hold gold reserves. Gold ETFs manage hundreds of billions. Gold is in every major portfolio allocation model. Bitcoin institutional adoption, early but accelerating. BlackRock and Fidelity ETFs launched in 2024. MicroStrategy holds $40 plus billion. Nation-states starting to accumulate. Financial advisors beginning to recommend it. Gold had a 100-year head start on institutional adoption. Bitcoin is closing the gap in decades. The trajectory of Bitcoin adoption looks like gold's adoption on a compressed timescale. Gold critics don't raise energy concerns. Bitcoin critics do. Bitcoin mining uses significant energy. Gold mining also uses enormous energy. Gold mining uses approximately 240 terawatt-hours per year, including extraction, refining, transport, and security. Bitcoin uses approximately 150 to 200 terawatt-hours. Bitcoin uses less energy than gold mining, yet faces far more environmental criticism. This inconsistency suggests the energy argument is often ideological rather than factual. Both assets have energy costs. Bitcoin's energy cost is more visible and measurable. That visibility gets weaponized against it unfairly. Gold has physical presence. You can hold it, feel its weight, admire its shine. For thousands of years, this physical reality reinforced its value in human psychology. Bitcoin is invisible, abstract, lines of code. For many people, especially older generations, something without physical presence cannot be trusted as a store of value. This psychological difference is real even if it's not rational. Over time, as digital assets become more familiar, this psychological barrier will diminish. But right now it explains why gold maintains broader acceptance among older and more conservative wealth holders. Approximately 50% of gold demand comes from jewelry, another 10% from industrial uses. Electronics, dentistry, aerospace. This demand exists independent of gold's monetary value. Bitcoin has no non-monetary use. Its entire value proposition is as a monetary asset. If Bitcoin's monetary value collapsed, there's no jewelry demand to support a floor price. Gold has this partial floor. Critics argue this makes gold more robust. Defenders argue this makes Bitcoin's monetary properties purer, no distortion from industrial demand. Gold's 5,000-year track record is genuinely impressive. Every civilization that used gold as money successfully preserved wealth across generations. Bitcoin has 15 years. It's survived multiple 80% plus crashes, multiple government crackdowns, multiple technical challenges, exchange collapses, regulatory pressure. It's still here and stronger than ever, but 15 years is not 5,000 years. Gold bears the legitimate argument that only time proves monetary durability. Bitcoin's track record is impressive for its age, but it's still a teenager compared to gold's ancient history. Ray Dalio holds gold as part of his all-weather portfolio. He also bought Bitcoin. Paul Tudor Jones called Bitcoin digital gold and bought both. Larry Fink at BlackRock reversed his anti-Bitcoin position and launched the largest Bitcoin ETF. Nation-states hold gold reserves. Some are adding Bitcoin reserves. The pattern from sophisticated allocators is not either or. It's both. Gold for stability and proven track record. Bitcoin for asymmetric upside and digital age monetary properties. The people managing the most wealth aren't choosing sides. They're holding both. How much of each should you hold? Depends on your situation. Conservative wealth preservation, 15% to 20% gold, 2% to 5% Bitcoin. Rest in diversified assets. Gold provides stability. Bitcoin provides asymmetric upside without excessive risk. Moderate risk tolerance, 10% gold, 5% to 10% Bitcoin. You believe in both, but are willing to take more Bitcoin risk for potentially higher returns. High conviction Bitcoin believer, minimal gold. Maximum Bitcoin you can hold without losing sleep during 70% drawdowns. You believe Bitcoin will eventually surpass gold's market cap. The honest answer, most financial advisors recommend 5% to 10% in alternative stores of value. The split between gold and Bitcoin within that allocation depends on your time horizon and risk tolerance. Younger investors with longer time horizons should weight Bitcoin more heavily. Older investors seeking stability should weight gold more heavily. Neither. Both serve different needs for different people at different life stages. Gold wins for stability, proven track record, universal acceptance, physical tangibility, conservative wealth preservation. Bitcoin wins for digital portability, mathematical scarcity, asymmetric return potential, confiscation resistance, digital age relevance. The honest answer is that they're complementary, not competitive. You don't have to choose. The binary framing is a false choice created by tribalism on both sides. Gold's market cap is approximately $15 trillion. Bitcoin's is $1.6 trillion. If Bitcoin captures 10% of gold's market cap, it would roughly double. If Bitcoin reaches gold's market cap, it would be worth approximately $750,000 per coin. If Bitcoin surpasses gold and becomes the primary digital reserve asset of the internet age, the price implications are far beyond current levels. This is speculative, but the trajectory of adoption, the mathematical scarcity, and the digital age tailwinds make it a legitimate long-term thesis. If you're 60 years old protecting retirement savings, gold deserves a significant allocation. If you're 25 years old building wealth over decades, Bitcoin deserves a significant allocation. If you're somewhere in between, a thoughtful mix of both makes more sense than ideological commitment to either. The gold bug who dismisses Bitcoin is ignoring the most significant monetary innovation in centuries. The Bitcoin maximalist who dismisses gold is ignoring 5,000 years of monetary history. The smart position is to understand both, respect what each does well, and allocate accordingly. Comment Bitcoin only, gold only, or both, and tell me your percentage split. I want to see where this community stands. Next video, I'm explaining the Lightning Network in plain English whether it actually solves Bitcoin's scaling problem, and what it means for Bitcoin becoming everyday money, subscribe to Unbanked. The old money had a head start. You have the internet.